If you're an accredited investor and you've been investing in alternatives like real estate, let me ask you something. When was the last time one of your equity deals actually paid you? I mean real, dependable income, not just hope and not just spreadsheets. Here's what I'm hearing out there from other investors. Distributions have been paused, reserves are now drained, and capital calls, we're nowhere close to being out of the woods. So if that sounds familiar, you're not alone and you're not stuck. Because while many equity deals are struggling to perform, smart investors are starting to turn to something more stable: debt funds. Let me give you 5 reasons why investors are making this switch. Number 1, it's predictable cash flow. It's all about cash flow. And if the deal's not cash flowing, guys, it's really not very fun. Unlike equity deals that can take 5 to 7 years to pay out, some debt funds can pay really quick, and they pay monthly or quarterly from day 1 or day 30 to day 60. There's no waiting for a refinance, no hope for a big sale, just consistent contractual income backed by real assets. Number 2, it's risk. The risk is lower. Why? Because in a debt fund, you're the lender. You're not the owner, and you're not in equity. Your capital is truly secured by the underlying asset. And in many cases, you're sitting, hopefully every case, in a first position lien, which means you're at the top of the capital stack. Now that is downside protection. But here's a quick warning. Not all these income funds are created equal. Some are just pref equity, which is capital calls in disguise. It's fancy terms that put your money at risk. And these things are just sometimes plugging someone else's capital call on a failing deal. So you got to be diligent, do your research, make sure it's a true debt fund, that it's secured, it's collateralized, and it's structured to protect you. Number 3, it's real estate exposure without, let's call them the headaches. Real estate exposure without the headaches. That's how equity was touted. It's not as safe, but you're still benefiting from real estate. You're just not dealing with the tenants, the toilets, the timing, the market, all that. The underwriting of the loan is handled. The loan structures are handled. You're just going to receive passive interest from day one, and of course that interest comes from the underlying real estate or whatever it could be. Number 4, diversification from equity. Over the last 5-10 years, people's portfolios have gotten really, really heavy in equity, and that may be where you find yourself. You're probably feeling some of the turbulence of that right now, because debt tends to bring more stability, a smoother ride. It helps balance out the riskier long-term equity plays, and we're out of balance. So it's like having ballast in a boat. It makes everything steady. When the water gets choppy, having these debt funds in place helps a lot. And number 5, I kind of call this a bonus. Huge. Liquidity is huge. So some debt funds offer liquidity within 60 to 90 days if you ask for it. That means you make an investment and it's locked up for about a year, and then you can ask for it back. You get all that income and flexibility and control all in one, and if you need your money, you can get it back much more quickly than an equity deal. So here's the bottom line. If your equity deals are slowing down, if your mailbox money is drying up, and you're tired of watching sponsors scramble to make ends meet, it might be time to think like the bank. And we're getting ready to launch a new debt fund from our Smart Flex Fund. It's designed for income first investors who want exposure to real deals, but also with real protections. So wherever you're watching this, click the link below to learn more about my Smart Flex Fund and the pre-vetted debt fund offerings that are coming up. And then you can see how you can start earning steady returns with less stress and way more security. So we listed 5 reasons why debt funds are attractive. I want to go off script a little bit, and we're going to talk about the different kinds of debt funds. So let me get the board cleared here, and we'll go into a little bit more detail on what's out there. The first kind of debt fund, let's call it this. We'll call it a fix and flip. Now, just about everybody I know knows what a fix and flip is. They're made famous by all the TV shows. But all this is, there are hard money lenders out there. Fix and flip guys are doing 2, 3, 5, 10 deals a month. Banks don't hardly like to loan to these guys. So in fix and flips, they're simply putting the money to work, and then they're bringing it back. And these funds can really show some really nice high returns. So that's a fix and flip fund. A second kind of fund, we'll just call it commercial, but this could be across a lot of different asset classes. Commercial loans. So sometimes people get in binds with their commercial property where they need money for a quick period of time, but they're willing to pay more for it. And some of these interest rates are crazy. They'll pay upwards of 20, 30% for short-term money, maybe 6 months, because they have a capital need in their business or in their commercial property. So commercial loans can be all across the board. We're looking at a fund that is really diverse across different types of commercial opportunities. So that's the second kind. Number 3, another different kind is just a specialty fund. I messed that up, but a specialty fund means it's really unique. It could be mobile homes in a mobile home park. It could be helping people get out of debt. It could be financing litigation for the law office, different things like that. So there's several different specialty funds out there that are really gaining popularity, and a lot of people are being drawn to these, again, because they offer stable, dependable cash flow. And the fourth one that just off the top of my head we could talk about is land. Now, when you see land being developed, a lot of times there was an investor involved in that land coming to market way before. He may have put that under option, and he put that under option 2 years ago, and then he went and started doing entitlements. Entitlement is when you go to the city or the county, you work with the planning commission to get it zoned from rural agricultural, you get it zoned from single family to multifamily, you get it zoned from residential to commercial. So that's how land goes. A lot of times you get guys who are in a situation, they've got a piece of land under contract. The owner, maybe they've extended the contract a couple times, and now the owner's just not going to let them extend it again. They've got to find money, maybe for 6 months. So what would they do? They're going to go to somebody who's going to loan them that money in order to go ahead and purchase it. The lender's going to take a first lien position on that land. They're going to continue to get the entitlement done. Maybe they're going to flip it to D.R. Horton or somebody that's going to build houses on it. So there's a lot of flexibility in these different types of funds. Typically, you're going to see that all of these are only going to put themselves at about 60 to 65% loan to value. So if the risk is diluted by that, these guys don't make loans. They don't want to take a property back, but sometimes they will take a property back, and then they will have to liquidate that property. They may have to even run that property or run that business or whatever it is for a period of time. And that's where you will see, in this sector, you'll see really good underwriting. They take very few risks because they don't want these properties back. But if they have to take them back, they will. And when they do, they've usually got something that they lent 65 cents on the dollar. It's pretty easy to liquidate the asset for 65, 70 cents on the dollar and recoup all the investors' money. So this is how debt funds are set up. Like I say, over the past few years, investors have been really heavy on equity. Reason being, the equity deals were cash flowing really well. But as interest rate pressure came in, that changed things. and you end up with all these default situations that we're starting to see. If you're in a multifamily deal or another commercial real estate deal that's just not paying any distributions, or worse, you've had to pay into it, reach out to me if you need any help with that. If you just want somebody to bounce the numbers off of, I'd be glad to talk to you and show you how we vet deals in order to avoid situations like that. You know, I'm not going to sit here and say that all those capital calls and all those investments could have been avoided, but sometimes the right questions in vetting and a little bit of experience in knowing, you know, I was around in 2008. I saw what happened in that economy. I've seen people get caught with deals they couldn't sell. Interest rate escalated like it did. Where else was interest rates going to go, folks? I mean, interest rates were in the twos, and you know where else were they going to go? You had to build in some safeguards there, and unfortunately, a lot of operators, they just didn't build that safety into these deals. So if you're in that kind of situation, reach out to me. I'd love to talk to you. I may not be able to do much more than just listen and hear what you're going through, and maybe help you decide whether throwing good money after bad is actually a good decision or not. So I hate it. I hate when investors call me and that's what they're dealing with. But my goal is to help you get diversified across so many asset classes and so many types of commercial deals that you don't have to worry about that kind of problem. So, again, if you want to reach out to me, click the link below. Let's connect. Let's see if we can get on a call together, or I can help you in any way possible. Just reach out and we'll get connected soon.